An LP commits $50 million to a private equity fund. What is the journal entry? If your answer starts with debit cash, you may already be in trouble because commitment is not cash. And that is exactly how private equity fund accounting interviews expose whether a candidate understands the full transaction or has only memorized debit and credit. In this video, I will take you through 10 practical interview questions from commitments and NAV to exits, carry, and clawback. For every question, we will cover the trap, the accounting logic, and the answer an interviewer actually wants. Let us begin. Question 1. Does an investor commitment create a journal entry? Usually, no. Suppose an LP commits $50 million on the signing date. No cash has moved. The fund has not yet received an asset and the investor has not yet funded capital. So in a typical structure, there is no general ledger entry merely because the commitment was signed. Instead, the amount is tracked in the commitment records and the unfunded commitment schedule. The interview principle is simple. A legal commitment may be economically important without creating an immediate accounting entry. Question 2. What is the difference between commitment, capital call, and capital contribution? Commitment is the maximum amount the investor agrees to provide. A capital call is the fund's request for part of that amount. A contribution is the cash actually received. Assume the investor commits $50 million. The fund calls $10 million. When the call becomes due, the fund may recognize a receivable from the investor and a corresponding capital account depending on the fund's policy and governing framework. When the cash arrives, debit cash, credit the investor receivable. After the $10 million contribution, the remaining unfunded commitment is $40 million. So never use commitment, capital call and contribution as if they mean the same thing. Question 3. The fund invests $8 million in a portfolio company. Does NAV fall by 8 million? No. The entry is debit investment 8 million, credit cash 8 million. One asset has been exchanged for another. Cash decreases. The investment asset increases. But there is no immediate expense merely because the fund deployed capital. The trap is assuming that every cash outflow reduces NAV. NAV generally changes when profit, loss, expenses, or valuation movements affect the fund, not simply when cash becomes an investment. Question 4. How does a management fee accrual affect NAV? Assume the fund accrues a $1 million management fee. The entry is debit management fee expense, credit management fee payable. The expense reduces the fund's net income and therefore reduces NAV. When the fee is later paid, debit management fee payable, credit cash. At payment, cash falls and the liability is cleared. But the NAV impact was already recognized when the expense was accrued. That timing distinction is what the interviewer is testing. Question 5. What is the difference between unrealized gain and realized gain? Assume the fund invests $8 million. At the reporting date, the investment is valued at $11 million. The $3 million increase is unrealized appreciation because the asset has not been sold. A simplified entry may be debit investment 3 million, credit change in unrealized appreciation 3 million. Now suppose the investment is later sold for 12 million. The fund receives 12 million in cash, but that does not mean the current period realized gain is 12 million. And it does not mean the total economic gain is only 1 million. This is where many candidates lose the thread. The carrying value is 11 million. The original cost is 8 million and the exit proceeds are 12 million. So what is the realized gain? And what happens to the $3 million of unrealized appreciation already recognized? This is where many candidates confuse three completely different numbers: exit proceeds, total realized gain, and the current period increase. Let us run the exit entry. Start with the sale. Original cost $8 million. Carrying value immediately before exit 11 million. Exit proceeds 12 million. Question 6. Is exit proceeds the same as realized gain? No. A simplified sale entry is debit cash 12 million, credit investment 11 million, credit realized gain 1 million. That 1 million is the current period increase above carrying value, but it is not the total economic gain from the investment. From original cost, the total realized gain is 4 million. 12 million of proceeds less 8 million of original cost. The prior 3 million of unrealized appreciation must therefore be reclassified. Debit change in unrealized appreciation 3 million. Credit realized gain 3 million. Now the three numbers make sense. Exit proceeds 12 million. Total realized gain from cost 4 million. Current period net increase 1 million. Three numbers, three meanings. Question 7. Is a distribution to LPs the same as profit? No. An exit creates cash inside the fund. A distribution is a separate decision to return cash to investors. A simplified entry may be debit partner distributions or the relevant capital account. Credit cash. The distribution reduces cash and investor capital. It does not create another realized gain, and it affects DPI because cash has actually been returned to investors. So say it clearly. Exit proceeds, realized gain and investor distribution are related but not interchangeable. Question 8. Is carried interest always recorded as an expense? No. This is a senior level trap. In many private equity limited partnership structures, carried interest represents a reallocation of profits from the LPs to the GP or carry recipients. The economic effect may be LP capital decreases, GP carry capital increases. Total fund NAV does not change merely because profit is reallocated between partners. But the accounting depends on the legal structure, reporting entity, LPA, and applicable framework. So never memorize one universal entry such as debit carry expense, credit carry payable. First determine whether this is an expense, a profit allocation, a liability, or an obligation recorded elsewhere. Question 9. Why might the GP return carry it received years earlier? Because early performance may not represent final fund performance. Assume an early exit generates $20 million of profit. At a 20% carry rate, the GP receives 4 million. Later, another investment loses 7.5 million. Cumulative profit falls to 12.5 million. The final carry entitlement becomes 2.5 million. But 4 million was already distributed. The excess 1.5 million may need to be returned through clawback. Clawback is not a penalty. It is a contractual true-up, so final economics match the waterfall in the LPA. Potential exposure may be monitored during the fund's life, but that is not automatically an immediately payable final clawback. The trigger, timing, and repayment mechanics depend on the LPA. Question 10. Which entity records the obligation? This may be the most important question in the video. Before proposing an entry, ask, are you accounting for the fund, the GP, the management company, or a carry vehicle? The same economic event can produce different accounting consequences in different books. The fund may have rights under the LPA. The GP or carry recipient may have a repayment obligation. The management company may not be the entity that received the carry. A strong candidate identifies the reporting entity before discussing debit and credit. Now let us recap. Commitment does not automatically create a general ledger entry. Commitment, capital call, and contribution are different events. Buying an investment usually exchanges one asset for another. It does not automatically reduce NAV. A management fee accrual reduces NAV when the expense is recognized. Unrealized gain becomes realized when the investment is sold and prior valuation movement is reclassified. Exit proceeds are not realized gain. An investor distribution is separate from the exit and affects DPI. Carried interest may be a profit reallocation rather than an expense. Clawback returns excess carry, so final economics match the LPA. And before recording anything, identify the reporting entity. Now imagine the interviewer chooses one question and asks you to explain the full accounting flow. Which one would you find hardest? Write the question number in the comments. If this video helped you understand the logic, not just memorize answers, Subscribe to the Fund Desk for more private equity and fund accounting interview breakdowns.